I wanted to break down what's happening with the stock market today, more specifically what's going to happen throughout the week. We've got an important economic data coming out on Wednesday, consumer price inflation or index. Also, PPI comes out on Thursday. How does this break down? How does this play into what the Federal Reserve is doing? The Federal Reserve has done a pretty good job of containing inflation growth. And from there, they've started to lower interest rates. But I have said many times that I believe that the Federal Reserve is going to have to do so at a very begrudgingly slow pace. And it looks like that possibility could play out because of some economic considerations happening in the future. We'll see how that plays out. Right now, let's deal with what's happening in the stock market today and what will happen throughout the week given the CPI data report we're about to get. Let's jump in. Here's a look at, this is actually the S&P 500 SPY stock, if you will. This is the 2-hour bar chart. You can see obviously what happened last week with the presidential election. All right, I've gotten a lot of questions coming in about interest rates, what's going to happen with there. I am going to put out a video on TLT stock in the next couple days. I had a bunch of personal things going on throughout the summertime, and I really had to pump the brakes so I could focus on that, then get back to where I am right now. So you should see a lot more consistency. I'm almost there with that, but I'm able to move forward. In the meantime, all right, President-elect Trump, we know will likely extend his own tax cuts to corporations. Because of that, stock market has rallied. But the stock market rallied for a second reason altogether. There's not any kind of noise. The stock market loathes any kind of turbulence whatsoever. So the fact that there's going to be a peaceful transfer this time without anybody saying that there was foul play happening, that meant the stock market could move forward. So it's a combination of both things. What the president-elect could do, plus the fact that there's going to be a peaceful transfer. We saw the stock market shooting upward. Now, given the economy that we have, we're about 4.1% unemployment rate. That is 95.9% of us are employed. Pretty solid number. Given that, the next thing we need to focus on is interest rates and, of course, inflation. We got the data points coming out this week. This is a look at the 10-year Treasury yield. Now, the stock market always defers to the 10. It's a good barometer as to what's going to happen in the 30 or the mortgage rate or the short-term rates. Now, the yield curve is looking really ugly right about now. They're not certain on a few things. Future deficit numbers are going to be a big problem going forward. We'll see how that plays out. But in the meantime, the bond yield, the 10-year Treasury yield, moved back upward. I don't expect this to move upward continuously. I know a lot of people are going to be keying in on that because of what I do for TLT stock, all of my commentary on TLT stock. Again, I'll hit that probably in about 2 days after CPI inflation data. So I see the 10-year, the yield on the 10-year is pretty much about as high as it's going to get. I don't think there's going to be any real problems moving forward with potential cuts in corporate profits. We're already there. So there's not going to be any kind of move forwards in that. The 10-year should ease off somewhat, but it really boils down to the driver of the economy. Government expenditures is about as flatline as it gets. Sure, continuously they're increasing. But governments don't necessarily decrease rapidly. It takes acts of Congress or legislators to move government expenditures. Because of that, that's a fairly flatline portion of our economy. The next portion of the economy, of course, is businesses, but before we get to businesses, we look at what drives businesses. The number of people employed, how much they're earning and spending. Personal incomes, personal expenditures, this is where I base all my analysis. Because people can be hired or fired pretty rapidly. Because of that, the growth in incomes and therefore expenditures changes sometimes rapidly. What we're seeing here is personal income versus personal expenditures, and for me this is the Bible. This is where I start. This is the year-over-year change in either. And as you can see, they fairly move hand in hand. The green is personal incomes, and we're seeing personal income growth on a year-over-year basis continually trickling higher. That means expenditures will follow suit. As you can see, the blue line there, personal expenditures year-over-year change, is starting to get there. A slight drag, but it'll continue to get there. As long as unemployment remains, say, sub 5%, which we used to consider 5% being full employment, as long as employment numbers remain below that, unemployment below the 5% number, we should continue to see incomes increasing while at the same time expenditures will follow suit. Given that, however, we look at, of course, interest rates, which the 10-year, as interest rates moved higher, consumers really haven't seen the effects of the interest rates declining on the short-term rate just yet. But we're still seeing growth in personal incomes and personal expenditures. Because of that, I can see a robust economy moving forward, all else equals. As long as nothing gets derailed. Tariffs. Make no mistake about it, American consumers will pay the price of tariffs. If you don't understand that, I'm going to do another video on that later on, but nothing gets passed off to China or Europe. It gets passed off to the consumer. So we'll see if he even does that. Part of me thinks he won't, that it's all just campaign. We'll see. In the meantime, Wednesday, this is what we're looking at. The headline versus core. Green here is the headline. We don't really care too much about that. It's obviously within a range that is normalized. So what that means when it comes to inflation is the rate of growth, the change from one year to the next, is normalized. We're not going to see prices dip below March 2020. They're just not going to grow at 9% per year anymore. The Federal Reserve did its job, stepped forward, raised interest rates, contained inflation. Unfortunately, the mortgage rates shot up as well. Lately, economists are attributing it to a few things, the deficit being number one. But the red line is what we're really kind of focused on. This is the core rate. The headline number has food and energy, gasoline prices, which tend to be very volatile. That core rate still needs to move lower in order to get contained in a manner in which the Federal Reserve could then push the pedal and lower rates faster. Right now, not quite there. But we'll probably get there considering the rates of growth. As long as the consumer doesn't go out of control and we start seeing even more employment gains. I don't see that happening, but I do see moderation on a very slow pace. This amounts to the Federal Reserve not being able to lower interest rates at a rapid pace. This is something I've covered many times in previous videos. So your key takeaways right now for the stock market. What's happening in the stock market today? What's going to happen this week and throughout, say, the early part of 2025? Incomes and expenditures for the consumer are robust. Businesses will follow suit. Business profits will not decrease because the tax cuts to corporate profits are going to be extended. Inflation is moderating. We're getting there with inflation. Employment remains robust at this time. As long as the consumer continues to see incomes increasing on a year-over-year basis, employment will follow suit. Businesses will continue to hire. Businesses will likely also continue to pass on some of the their profits into employment gains and incomes, which would continue to propel the economy and, of course, the stock market today. So, given the information we have right now, we're still moving forward. The stock market today is down modestly, not even worth bringing up, basically flatline. What could happen is we see a moderation in the stock market because it rallied pretty robustly. But all else equals, we should continue to see the economy moving forward and therefore the stock market following suit. Make sure to hit that like and follow button. I've got my Substack newsletter. The link is down below. We'll see you in the next video.